So here's the 9 questions to ask any hard money lender before you commit to a loan. So yes, cost is important, but there's some other things we need to make sure to put you in a safe loan before you jump in and do that commitment. So number one, your goal should be to make sure they can actually close, that they could actually fund a deal. Are you talking to a broker? Are you talking to a direct lender? Whatever way you go, you just want to make sure they can fund. One of the worst things you could do in real estate investing is get a property under contract from a wholesaler or even just a private individual and not be able to close it, not be able to fund it. Especially if you're working with wholesalers, they're not going to keep sending you deals if you're not working with a lender who could actually close. So verify, get some referrals, see and make sure that they are the one funding or that they control the funding and that it's going to happen and happen on time. You don't want even delays. You don't want week, 2-week delays just because of the lender. Number two, will he actually be able to fund what you need? Will he be able to cover everything that is going to make this a successful transaction for you? From purchase to rehab to any of the closing costs to maybe even the payments. Do you have that all covered? And if they're not going to cover it, do you have that covered with HELOCs or lines of credit or cash? Will you be able to properly fund this deal from start to finish, from close to close? Because the last thing you want to do is be short on funds because that just slows down a project for you and it's just going to cost you more and more money. So number two, make sure that they are going to fund the amount you need. Number three, is the price right for your timeline? Every project has a different timeline. Some you may be in only for a month or two, and others you may be in for 9, 12 months. So sometimes it's better to pay more points and a lower interest rate, and sometimes it's better to pay a higher interest rate and less points. Don't worry about that. We have a tool down below. You can put in any 3 lenders and see what's best for that project. So number 3 is making sure your timeline for that project is going to be best suited for the lender you're looking at. Number 4, what is it going to cost you as far as interest rate? What is the interest rate that they have on that loan? And is it the best that you could get for that particular timeline again? And is that interest rate going to start charging you for your escrow balance that you're not using yet? Is there a stated number of months that you must keep the loan? There's a lot of loans out there that you have to keep the loan at least 3 months or you pay their interest anyway. And what is their default interest? If something happens, something comes up, what can they charge you as far as a default interest rate? So know before you sign everything about their interest rate. Number 5 is points. Remember what points are? That's a percentage of the loan you're taking out that they charge for, call it origination or a fee to the lender. For example, if it's 2 points, that means it's 2% of the loan amount you're taking out. 2% times, let's say your loan is $200,000. That's 2 points is 2% of $200,000 or $4,000 that is going to the lender for their origination. And typically, the lower the points, the better. Unless you're looking at different terms, throw an example out there. Let's say someone's charging you 3 points on a loan, but they're going to give you 12, maybe 18 months on that loan. So they're giving you a longer time period or term for that loan, where someone else may charge you 1.5 points, but they're going to give you 6-month term, which means what? After 6 months, if you go past that, they're going to charge you that 1.5 points again. You also have to put it in context of, how long the term is for that loan. And once again, does it match up to your project and how long you need that money for? Number 6 is all the other fees that are put in to a loan by lender. Some lenders have only those points that we talked about. Other lenders have a bunch of other fees: underwriting, appraisal, draw fees, setting up your escrow fee, wire fees. You got to take everything into account because at the end of the day, when you actually close out, let's say it's a flip, you close it out, you're going to have to add up all those fees, all that interest, and that is the cost of your money. So there's lenders out there who charge underwriting fees, processing fees, doc fees, the legal fees. Check out your LLC fees. I need a draw fee. I need an inspection fee. You need to understand all of those fees because that is hitting your bottom line. So know exactly what they're charging you from that interest, from the points and all those fees. Number 7 is the limits. What are they going to offer you as far as the limits on their loan? Meaning, are they giving you 70%, 80%, 90%, maybe even 100% of the purchase? And then if you're doing a rehab, are they going to give you 80, 90, or 100% of that rehab? What are the LTVs, the ARVs that they're using in their formula? and does it match up with what you need for this particular property? And I say that because there's a lot of borrowers out there who always have those deals that may not fit their typical lender, that a hard money loan works better for them because of that timing, because of how much they could actually get from a lender and the percentages that they're going to, make from that project. You got to remember this is all about making money. So you want to make sure that the money aligns with the deal that best suits you to make sure you're making that money. So make sure you understand that each deal is specific and the lending limits may be better with one lender for one particular project compared to another. It might be a pop top. It may be, you're doing an addition. It might be a land. It might be adding a mobile home to land, something like that. Different lenders have different limits, how much they're going to lend you on that purchase, the rehab, or put it all together. And that's why it's good to have that loan cost optimizer below. So you could check out that specific project to make sure you're getting the best deal for yourself and the deal you're working on. Number 8, they're going to ask you how much experience you have in real estate investing. I mean, a lot of lenders out there want somewhere between 2 and 5 deals under your belt in the last 3 years. There's also plenty of lenders out there who will, lend to first-time investors. So make sure when you're talking to your lender, you go through all of these questions that we're going through, because part of it is maybe they do have enough or they will close on time. Maybe they have good rates, good percentages that they're going to give you. But if you don't have 5 deals in the last 3 years, you're going to be, put into a different bucket, and they may cut the ARV, the loan to value, everything that they're going to offer you just because of your experience. So make sure you ask them exactly what they need to see, what kind of proof they need when they're looking at experience. A lot of what we call the big Wall Street companies out there, they like and will give better terms to those who have experience. Hard money on the other side, probably a lot more flexible than the Wall Street people out there because they're just looking at the deal. They're looking for people who understand what they're getting. It might be a construction worker who's now coming over and starting to do flips. It might be a realtor who's starting to come over and they've seen it from the outside plenty of times. Now they just want to jump in and do it themselves. So they have experience on part of it, maybe just not the whole thing, but that really works for a hard money lender. And some of the big Wall Street companies, they want you to have that, like I said, 2, 3 to 5 deals done. Then they'll jump in with those, good terms, good rates. So sometimes it's just like starting at one place and graduating up the lending scale. Last one is credit scores. Most lenders out there that are not pure hard money lenders really focus on the credit score. The better the credit score, the better the terms you're going to get, which means the higher the loan to values they're going to give you. They'll give you, 90 instead of 80 if you have a good credit score. They may give you 100% of rehab if you have a good credit score. If you don't, they may only give you 80 and 80, meaning 80% of the purchase, 80% of the rehab. Credit scores matter when you're talking about large institutions. Hard money lenders, small hard money lenders, they look more at the credit. They make sure you're, paying things on time. They understand the business of real estate investing comes down to using credit cards, which means your usage may be high, which may, just drop that credit score for a little bit. But it's not because you're not paying. It's because you're actually in the business. And when that next deal, refinances or gets sold, you're going to pay those back, those credit cards back off. Your usage level is going to go back down and your credit score is going to go up. That's not a big deal for true hard money lenders. But when you're looking at, like I said, the bigger companies out there, they are going to be credit score driven. So if you're in the mid 700s, they're going to love you. They're going to give you great terms, which means higher loan to values, better rates. Lower points, if you're in the 600s, quite the opposite. So when you're out there looking and they don't like your credit score, and maybe looking for a hard money lender. I just want to make sure you understand that money is important to keep the wheel going. You got to make sure that they're going to fund on time, they're your lender, because you want to keep your wholesalers happy. You want to keep your sellers happy. You want to keep the good deals coming through. But on top of that, you want to make sure you have all the money you need at the cost that you can afford. That'll bring more money into your life, into your world when you're, flipping, or even if you're burning the property. So running through these items, running through our loan cost optimizer is a great way. That's a great tool to make sure that for this particular project, depending on how many months you're going to have this deal, the kind of rehab you need, the interest compared to the points, put it all in there. Let it run the numbers and see what's best for you. And remember, I'm a hard money lender, but I still want you to get the best deal. That's why we have these tools. That's why we run through this. And it's just important that you see the whole picture. And that whole picture is funding is so important. It is half of real estate investing. You need the money to make the money. Let's just make sure it's good money for you. So there's 9 things again. Make sure they could close on time. So important in this business. Number 2, make sure they could lend the money that fits into your budget, the amount you need. Number 3, make sure that the funding aligns with your project. Don't get into like a 6-month term when you really need 12 months. Number 4, interest. Make sure you understand the interest, not only the note interest rate, but the default interest rate. If there's a guaranteed amount, anything that may pop up with the interest rate, understand everything about it. Very simple to do, once again, by using that tool. Next is origination. Know what the cost of origination, and it really comes down to term versus the cost with the loan. Next up, number 6, fees. Check the fees, run the fees, know every fee that you're going to pay from close to close from that lender. Number 7, know the limits that they're going to lend you. Number 8, know what they require for experience. And number 9, know the credit score. Make sure that your credit score matches the lender that you're looking to use. Get your money right so your project's right. Use that loan cost optimizer, subscribe, like, and we'll catch you on the next video.